Hi guys, Brown Asset Management here, and today I'm doing a stock review of the Walt Disney Company, ticker symbol DIS, using my 7 simple steps. Let's first look at the share price over the last year. At the start of the year it was around about $111 a share, hit a 52-week low of $79 a share in the pandemic, and has gone on a pretty strong rebound since then and has breached its all-time highs and eventually hitting its all-time high at $200 a share, but has now leveled off slightly and is now at $189 a share. If we compare Disney to the market over the last year, you can see that Disney has been pretty flux with the market, but then has broke past it in September and has gone on pretty high tests since then. So it has beat the market quite handily in the last year. If we go to the last 5 years, you can see it's been pretty neck and neck, with Disney just beating the market over the last 5 years. So if you bought Disney instead of the S&P 500 over the last 5 years, you would have made a little bit of money, but if you bought Disney this year, you would have made a lot more money than the market. So looking good for Disney so far. So looking at step 1 of my 7 simple steps is the PE ratio less than the market, and Disney does not currently have a PE ratio because they're not profitable, so that is a fail. And also we'll fail our second step is the PE ratio less than the sector. Disney is in communication services, and that is a fail again because they don't have a PE, so that's 2 fails off the bat, not looking good. Now looking at step 3, has the revenue increased over the last 5 years? And the revenue has gone from 55 billion in 2017 to most recently at 75 billion, so there's a check mark there, the revenue's increased. Now looking at the net income, and that's gone from 8.9 billion to just over 10 billion, so that's another check mark there, the profit has increased over the last 5 years. Now on to step 5, are the shares outstanding decreasing, and the shares has gone from 1.5 billion to 1.8 billion, so that is a fail. The shares have increased over the last 5 years. You can see some years they did buybacks and then they issued more shares in these 2 years. It is a fail. Disney are capitalizing on their high share price at the minute, so it's not completely unheard of that they are increasing their shares, but still a fail nonetheless. Right guys, just want to quickly thank you all for watching. Please leave a like if you've enjoyed the video, give a comment on your thoughts on Disney, and consider subscribing if you enjoy stock analysis videos. Now on to my next step, are the current assets greater than the current liabilities? So the current assets of Disney are 35 billion and the current liabilities are 26 billion, so there's a check mark there. They can pay off all of their current liabilities with their current assets. That's good. Just looking at their total liabilities, that's 130 million, so they're nowhere close to paying that, but no extra check mark, no crosses, just they can't do it. And the final step is the free cash flow increasing over the last 5 years, and the free cash flow has gone from 8.7 billion to 496 million, so that is a check mark there. The free cash flow has decreased quite dramatically, which is a bad sign. If I take an average of the free cash flows, that gives me an average of 4.87 billion, which is considerably higher than their current free cash flow, so I will be using that for my calculations. So to get the enterprise value of Disney, I add the market cap to total debt minus cash and cash equivalents, and that gives Disney an enterprise value of 386 billion, so that gives a average free cash flow yield of 1.26% and a ratio of 79. So those numbers I'm not liking at the minute. Normally I would like anywhere between 3 to 5% and a free cash flow ratio at around 20 to 30, so that is not the best news for Disney. Disney does not currently pay a dividend. They stopped their dividend in 2020, so I can't go through that. That's actually a negative. Normally I would just go through, but because they previously were paying a dividend and are now not, that is actually a negative point. Just going to quickly go through some ratings here. Overall, you can see that out of these analysts, the majority have it as a hold, buy, or strong buy, so that's very good news on Disney. Analysts are quite bullish. The recommended rating has it firmly on a buy, and the price analyst targets range from a low of $124 a share, but at an average of $205 a share, and the high side at $230. So analysts are very bullish on Disney at the minute, despite the issues it's having with the pandemic, so that's a very good sign. And looking at Simply Wall Street, they currently have it overvalued by 40% with a fair value of $135 a share. So Simply Wall Street looking probably at the free cash flow again, or giving Disney a overvalued rating. So not bullish compared to the other analysts. So just to quickly summarize my 7 steps. PE ratio less than the market was a fail as Disney doesn't have a PE. PE ratio less than the sector was also a fail for the same reason. Revenue had increased from 55 billion to 75 billion, so that's a pass. Profit has also increased from 9 billion to 10 billion, pass again. Shares outstanding have unfortunately increased from 1.6 billion to 1.8 billion, so that's a fail. Disney can pay off their current liabilities with their current assets, as they have 35 billion to 26 billion. and the free cash flow has not increased from 8.72 billion to 0.5 billion. So that is only 3 passes and 4 fails, and in fact I'll actually give them an extra fail for removing their dividend. So that's 3 passes to 5 fails, which is not a good look for Disney. So now looking at my models, I have a discounted free cash flow analysis here and a Buffett-Graham intrinsic value calculator here. So the discounted free cash flow currently has Disney at a calculated stock price of $38 a share, which means it's currently 80% overvalued. That does seem very low to me, but based on the free cash flows over the last 4 years and then me trying to extrapolate out, I think this number is not too unrealistic. I understand they have been hit pretty hard these last 2 years, and especially in the last year. Let me just rejig the numbers a little bit here and see if I can get a number that I think is a bit more fair. So I've redone the numbers and used the free cash flow rate of the year of 2017, and that's give me a calculated stock price of $93 a share. So once again, this model is not saying Disney's a buy, it's saying it's too overvalued at the minute. Would have been a great buy at the start of the year, but not so much now after the big climb. And looking at the Buffett-Graham intrinsic value, that has a fair price of $109 a share and a Graham price of $82 a share. So once again, both of these models saying Disney is not a buy. Before looking at my 7 steps and the models, I would have thought that Disney was a buy in my estimations. I think they've got great room for growth. Once they come through the pandemic, they'll be firing on all cylinders again. But my worry is just that the share price has corrected a little bit too quickly and actually hit all-time highs before the pandemic is over. So a word of warning from me, if I was to buy the shares, I don't think I would do it at the minute. If there was a pullback back to its original one of around $100 a share, I would definitely be back in there. But right now, I just can't justify it at almost $200 a share. And finally, just looking at some of the technical analysis here, I have a 50-day moving average in grey and a 200-day in red. As you can see, in September there was a golden cross, so that was a massive buy signal, and you would have bought then and held the entire way up to $190 a share, so that would have been a great purchase. There has been a lot of bullish signals throughout. The 50-day moving average was broke by the share price in November, which signaled one of the big boosts for Disney again, so that would have been a buy signal. And right now the share price and the 50-day moving average have had a consistent thing. They are coming back together a little bit, but they are still very bullish signals. So based on momentum alone, I'd say Disney is still a buy based off the technicals, but off the fundamentals, I'm not too sure. Right guys, I want to thank you for watching. Give a comment on your thoughts on me using Yahoo Finance over Interactive Brokers. I've had a lot of issues with Interactive Brokers over the last couple of days, so I've moved to Yahoo. Tell me if you like it more. Do you think there's a difference? Is there anything I can incorporate that you enjoy that I've missed out here? Give a comment on your thoughts on Disney, and consider subscribing if you enjoy investing and stock analysis videos, and I'll catch you guys next time.